Good morning, everybody. Thanks for joining the session. My name's Kevin Ramsire. I'm the CEO and Managing Partner of Vestacore Advisors. We're a nationwide mergers and acquisitions firm. We help with exit planning, strategic planning, and sell-side and buy-side representation. Got here early this morning. I was walking around some of the booths and I found some literature, and I was just reading it, and it said that it was an interesting stat. It said babies born this year, because of advancements in technology, we're expected to live to be 140 years old. And the first thing that I thought is we're going to have 110-year-old parents whose 85-year-old kids had to move into the basement, right? And they're asking for the keys to the car all the time. So this is an interesting convention. We speak at a lot of these. Last time I was here was about 3 weeks ago for speaking at a different association. And on my way here, I was sitting in the plane and there was a child behind me coloring. And I tilted my seat back and the whole plane started laughing, and I turned around and this little kid had a permanent green Sharpie, put a big X on the top of my head, so I had to go and do a presentation with a giant green X on my head, so it was a great icebreaker. Today we're going to talk about how to maximize the value of your business, and we believe that's important for two primary reasons. First and foremost is over the next decade we are going to see the largest wave of transfers, exits out of businesses than we've ever seen in the history of this country. There's a massive transfer of wealth happening, and we'll talk a little bit about that shortly. But for the purpose of this presentation, it primarily revolves around the second reason. And we believe, just from the clients that we've worked with and from our own experience operating businesses, is that managing a business with value in mind is the most efficient and best way to run a business in general. So we'll talk about that moving forward. Before we move on, though, a little bit about my background. Anyone know what city this is in the United States? Any guess? Cleveland, Ohio. So I didn't expect anyone to guess that. I'm a struggling Cleveland sports fan, Cleveland Browns fan, so hopefully you can feel my pain. I started my career at a large global investment manager called Invesco. Worked a lot with them on larger mergers and acquisitions. I also was a founder of a company called Ram Financial. We built that up and sold that to a public company. And I was also the founder of a company called SWAT Environmental. We started that with one employee. We grew that nationwide very quickly. And in fact, we were nominated 2 years in a row by Inc. magazine as one of their fastest growing private companies. And one of the things I'm probably most proud of is we were recognized as one of America's advanced sustained growth companies in the Build 100 list. And the reason I bring that up is because it really falls into how we work with clients on maximizing value. And each of those, and every business that we've operated, we've built that with value in mind, managing to the value of the business. And we'll talk a little bit about that. Today, I started Vestacore about 5 years ago when we got some press for some of the other companies that we had worked with. My phone started ringing and people were saying, "Can you help me do that with my business?" So I was on a plane nonstop doing that over and over, and eventually it formulated a business. And today I have 3 other partners, and we're fairly small. We've got 12 people under us. We have offices in Boston, Denver, and in Michigan. But we work with companies all over the country. And we basically represent smaller and middle market businesses, and we help them do one of 4 things. Most of our business is on sell-side representation, so we come into a business and help them find the ideal buyer, maximize their value, and take that to the marketplace. We do represent several larger companies as well on buy side, so they'll bring us in to help them find acquisitions and targets to buy. We work with companies on growth capital, so if they're experiencing a lot of growth and they need some working capital or they need capital to expand, we help them raise capital. And finally, we act as principals in some transactions where we'll actually invest our own capital or the capital of our clients in those companies that we like. So we don't call on business owners. We tend to work primarily with, we call them centers of influence, and that would be trade associations like this that help us stay connected into what's happening within an industry. The CPA firms across the country often refer us, financial advisors, our wealth managers, and then several banks we work with as well to represent their clients. My legal department had made me put this slide in there, so there's no guarantees in this slide. We're not giving tax advice or offering legal advice. So John, our legal counsel, would be happy that I included this. So let's get into the agenda. I want to go over quickly some facts. We want to talk, before we learn how to increase value, I think it's important to understand how outside companies view value. How do they determine value within a business? Then talk about primary drivers of valuation, some of the levers that we can pull within businesses to increase value. And then how do we improve that? Are there things that we can do systematically or strategically within a business that can help improve those values? And then we can open it up for Q&A, and I'll be around for the rest of the conference as well. So I alluded to this earlier, but 70% of companies are going to attempt an exit by the year 2030. So not only is this an interesting time for our business in the mergers and acquisition field, it's also an interesting time for business owners that we work with, because simple economics 101 will tell you that the more businesses that come to market, the more strain that's going to have on valuation, simple supply and demand. So this information becomes more pertinent than ever before as time goes by. What we see, though, is 80% of companies that want to sell are actually turned away by most M&A advisors because they're not what we call market ready. They're not ready to sell. And we call it a gut punch. The last thing we want to do is position a client into the marketplace when they're not ready to sell. Of those remaining 20%, 40% of those businesses that are on the market actually will never sell. And only 8% of those sell higher than what they went to market for. So we believe these stats are extremely important to look at, to watch, to monitor, so that we know how to better improve these results for our clients. When we look at a company initially, we look at four categories, and we rank these from lowest to highest, and we try to classify companies in here. And we call this first type of company person-driven, or sometimes we refer to it as owner-driven. And this is the classic kind of business where the owner wears 8 hats. They're doing the marketing, the sales, the research and development. They're helping with production. They have created themselves a pretty good job. They're getting up every day, and they roll their sleeves up and they work in the business. These have the lowest value in the marketplace, and you can make assessments why. Outside buyers look at this and they want to buy systems, processes, and procedures and management teams, and these types of businesses tend to get the lowest valuation. So when we find businesses like this, our job is really to kind of help them advance to the next level, and that's more of a team-driven approach where the owner has looked in the mirror in the morning and said, the only question I have to answer every day is, how do I get someone to do what I'm doing today, and build a team on that. So we help owners transition from that. The next one that we see tend to get higher valuations are process-driven. And that's when we see businesses that have extremely well-defined processes, procedures, and production capabilities where they can plug talented people in to do those roles. We often say, you don't want to tell people what to do, you want to tell them exactly what to do. And then finally, are culture-driven. Culture-driven companies by far get the highest multiples in any industry, and those tend to be the companies that everybody in the industry has heard of. They either have a dominant product, they're growing the fastest, and many of the employees in that industry or the professionals want to work for them. So let's talk, before we move on, about why we see most businesses come to market and fail to sell. And this is something that, as someone's managing for value, they can kind of think about and manage to. The first one is by far lack of preparation. We've alluded to that a little bit on how we can prepare a business for sale, and we'll talk about that more. Number two is an unmotivated seller. This process can be an emotional roller coaster ride. At the 11th hour, something always goes wrong, and you need a strong team on your side that can help quarterback some of the ups and downs of the process. Many business owners have a concept that their business is worth a lot more than it actually is. So we try to manage proper expectations and set them properly up front. I was just on the phone yesterday with a new client, a potential client, and was saying that one of the competitors got an 11 times earnings on their business, and they think that they should get that as well. And I tried to tell him that that client or that company didn't have 70% of their revenues coming from one client, which he did. So that you have to look at things a little differently. Every company's different. We see poor marketing as number 4, and not so much on the business side, but on the deal team side. So we see a lot of good companies come to market, and they might only position it to the 4 or 5 companies that they think are going to buy the business or value the business, when in fact we want to flip over every possible rock, get as many eyes on that business as possible. And then finally, I would call this unsophisticated lawyering, if lawyering is a word. We see a lot of businesses that started small 20, 25 years ago. They have the same attorney that helped them create the business, establish the corporation, and they're sitting across from a private equity firm negotiating. So we want to bring those people on the deal team, but we always encourage our clients to hire a qualified mergers and acquisitions attorney that has done this over and over, so that they're not that they can hold their own in negotiations. So let's talk about how outside either strategic buyers or financial buyers, private equity funds, would look at putting value on a business. Many of us here probably own mutual funds, stocks, bonds, and what's great about those is you can go in the newspaper or online on your mobile device every single day, and you can see what the value of those are at any given moment. Unfortunately, with private businesses, that's not the case. Maybe I should say fortunately. I had someone tell me this last week. They're like, hey, half of my management team was sick for 2 days, and if I could see the price of my stock those 2 days, it would have plummeted. So maybe it's good that we can't see the valuations of those. But my point is that it's easy to derive a valuation on a publicly traded company versus a private. And one of the and just because of lack of time, I won't get into the details of this, but Warren Buffett uses, he's a proponent of net present value, as are many buyers of businesses, where really they look at the value that a business will produce as far as cash flow in the future, and then they'll discount that to an appropriate rate to put a valuation on it. Basically what that means is if I was looking at an investment that I felt could pay me $1,000 over the next 10 years, I'm not going to pay $1,000 for that today. There's no way any of us in this room would pay $1,000 today for $1,000 over the next 10 years. There's a time value with money, so we would discount that to an appropriate rate to meet our return expectations. But at the end of the day, what it really comes down to is valuations are multiples on EBITDA. You'll hear this a lot in industries when you hear valuation methodologies. What's the multiple that buyers are putting on EBITDA right now? Earnings before interest, taxes, depreciation, and amortization. So that's something that we always focus on. We want to get our arms around each industry where the EBITDA multiples are, and the things that we can do to increase that. Then the next step that a buyer will take is they'll take this standard valuation of an industry EBITDA, and then they'll apply risk premiums to that. And basically what that means is they'll get a valuation, EBITDA times X, whatever that number is, and then they're going to try to justify chipping away at that whole number as much as they can through risk premiums. And there's a whole host of those in every businesses, and we'll talk about how to manage to some of them today, but they will try to make a determination if they want to pay that multiple or if they want to take away from that multiple. So let's talk about some of the things that we see drive valuation, and this goes both ways. Some of these things, if businesses don't have them, can be a risk premium and start taking away from that multiple. Number one is surely size of revenue. We see the bigger companies tend to be perceived in the marketplace as safer investments, and therefore they would pay a premium for those. We talked a little bit about EBITDA, but not only historical EBITDA, but projected EBITDA. We want to take a look at that and make sure that we can justify the growth projections in there. This often goes undiscussed, but we look at revenue stability, or I call it revenue surety. How sure are you on your projections? What are the triggers that might either hinder us from hitting those projections or enhance us the probability of us of increasing those projections? Margin percentages. So many companies will do an analysis on your margins by product, by geographies, by salespeople, by company in general. So they will really go through this with a fine-tooth comb. Return on assets. The growth potential, we like to build narratives. We find that although there's a science behind this, there's also an art. And the art is speaking of the growth opportunities depending on the buyer here. So we want to build strong narratives around areas that our clients are missing. And it's interesting when we go through this process with clients, when we ask them to identify their top 3 or 5 growth opportunities, they just never got around to it, or they don't have a strategy to attack it. It's very interesting that you can see how much, call it meat left on the bone, that they're leaving. The opportunities that are in front of them are typically pretty strong. And this can play a big part of valuations as well, particularly for a strategic buyer. If someone in the industry is looking to get a geography that you own or a target market that you own, a specific segment of the market that they haven't been able to acquire, we see oftentimes companies will pay premiums for that as well. So if you're setting on something that someone doesn't have, that's a great driver of valuation. Customer concentrations are very, very important. If you're driving a large bulk of your revenue from 1 or 2 or a handful of clients, we want to make sure that we can smooth that out a bit. I would call these secondary drivers of valuation, and in some cases they can be primary as well, depending on the company. Financial controls. What systems do you have in your financial reporting structure that make sure that are your financials reviewed or audited every quarter? What do those look like? The quality of the asset base that you hold within your business, the age of that equipment or machinery or whatever you're using. And then the competitive landscape is where do you set kind of in the food chain? What are the opportunities of the people that are just ahead of you and just behind you? Who's catching you? Things like that. We want to look at asset turns. How long are you holding on to assets? How long does it take those to turn over? And we talk a lot about this. We spend a lot of time talking about management teams. And it seems to have picked up over the last 2 or 3 years where outside buyers are looking favorably on strong management teams. They're going to acquire the talent and the know-how. So we want to make sure that there's any staff deficiencies that we address those before going to market. And then the material and equipment demands within your business. And how are the vendors or suppliers changing? What are we getting the best terms that we can? Quality control. How do we handle that? What's your processes for that? Do we have well-written documents that outline that? The facilities. Any regulatory issues within the industry? And I know some people were taking a picture of that, so I'll keep it up there for a second. And then there are some other potential drivers of valuation. We look at people turnover. How often are you turning over staff in critical areas of your business? What's the training to attract and retain high caliber people? What's the local talent pool? How are you able to source talent in the geographies that you serve? What are your operation systems? And then there's a whole host of these ratios, and one of many are payroll percentage of sales. We'll run a whole list of these and look at what these look like versus the industry or a competitor. And then any legal issues that the business has faced in the past or may face in the future are going to be important to have a narrative around to talk with potential buyers. And then what are kind of the barriers to entry or the hurdles to operate in the industry? Are there any certifications or specific licenses that need to be had? So now that we've talked about, those were, I would say, the 3 levels of drivers of value. How do we improve this? How do we look at our business in a holistic approach and say these are the primary components that we need to increase value on? So we're going to talk about 5 things. First, taking a look at the state of your company, the state of the competition, assigning certain benchmarks to the findings there, ranking those issues in an order that makes sense of urgency, and then creating a plan around that to execute a value improvement plan. So I'm not going to go through all of these, but I do want to lay these out. So when we look at a state of the company, first we start at the top level with the expertise. What is it that you bring to the table? What is your unfair advantage in the marketplace? And we try to drive a strategy around that. What are the production capabilities? How are you at max production? Where are you at 100% capacity? What would the business look like? Product and service capabilities. What's your geographic reach? The selling proposition that you have in the business. And the management team, we'll talk a little bit about that in a slide in the future. And then again, we look at cost structures, and we look at that by product, by segment, by department and geographies. And then what are the margins in each of the product lines, potential growth rates, what's your marketing plan in the business? And then what we do is we come up with a report that kind of guides us and says these are the things that we're going to need to change. But before we do that, we do the exact same exercise on the 3 to 5 competitors that you have identified in your business that make sense. So we try to do the same and do an overlay of where your strengths are versus the competition. So these would be the same checklist of things for the competitors. And then with this data, we want to come up with a benchmark. You have to measure these things. So what we'll do is we'll benchmark some of these items through past performance of the company that we're working with, so our client or your company. We benchmark this to that of the competitors, and then we use industry data to look at these averages and try to benchmark it to the industry. So we want to make sure that we're exceeding the benchmarks here, so that when we do go across from a potential buyer, we have enough ammo to justify a higher valuation. What's important to note is sometimes we'll create these industry norms or averages or benchmarks, and it's not enough just to get to those. We've got to exceed them. We've got to make a strong case that we are exceeding these industry benchmarks and we're defending the valuation that we've put on the business. And it's no surprise that the companies with the higher valuations have much stronger averages and key metrics than the industry as a whole. Now what we're left with is 50 to 100 of these key levers that we can pull to drive value. And you can drive yourself crazy focusing on all of them. We try to pick the top 3 to 5 that we believe are really, really going to make an impact. And we build a plan around that. And that plan of execution really measures timeliness, costs, and accountabilities for each of those that we would track either on a weekly or monthly basis to see where we're going. Let's go a little deeper dive into a handful of some of the things that we've talked about. I'm going to talk a little bit about management team. Does anyone know who this team is? Who this management team is? Look in the bottom left. It's Microsoft. That's young Bill Gates down there. I always say, could you imagine this management team walking in looking for investment capital? You might laugh them out of the building, but they got a lot of no's, but the yeses that they got sure paid off. So when we work with a management team and we try to depict when we try to find the hidden value there or lack thereof, it's surprising how many companies don't have an updated organizational chart to start with, and very detailed job descriptions on, how do you hold people accountable? What's the opportunity for them to advance in the organization? What are the benchmarks that they have to exceed to move up? The management team bios, we see a lot of companies that have no employee handbooks or nothing solid that an employee can really lever and lean on. So these things seem basic and intuitive, but you would be surprised. 70% of the businesses we work with fail in this area of setting proper expectations for their employee base so that they can attract and retain the best people. and very rarely do we see reviews even done. So, in a due diligence, when a company comes in and they're going to rip apart a business to look at it and find weaknesses, they're going to ask to see employee files. And a well-documented review process that shows where there's weaknesses and strengths within the organization is a powerful thing to have. We look at operations, and we say this a lot. I've said it before. I've said it today already. Is we don't want to tell people what to do. We want to tell them exactly what to do. So having a very, very detailed standing operating procedures. We've seen businesses have one sheet that outlines a whole production line, and it's just not enough. We need to know every possible step that a job function performs so that they can do it right. Equipment, the maintenance and repair records on equipment. This just happened to us mid-year last year. We ran into a situation where they didn't have proper records. The equipment was worth a lot of money, but then it was a little dated but still operational, but they didn't keep proper repair and maintenance records on the equipment, and that hurt them. So we want to make sure that we keep all of that. And then the safety record. And I'm going to bring this up because of the importance here of thinking about areas for growth within a business. Could really make or break, another point on a multiple. So we want companies to try to look at and think about, are they missing different products or services? What can they do to increase their production capabilities within their business? And what type of plan can we gear to go after those? What are the possibilities of geographical expansion? What geographies are you really strong in, and why can't we replicate that in another market? A lot of business owners have blinders on. They kind of get tunnel vision and they can't see outside of their existing business, so we try to get them to do that, at least initially. Are there any new customer segments that your brand or product or services or that can offer or go into that you might not be aware of right now? What people are we lacking? We talked about people deficiencies, but oftentimes looking at what are the one or two key job positions or people that we could put inside the business to help it as well. And then this surprises us as well. There's a lot of great technology out there driving business operations and efficiencies, and a lot of business owners, for whatever reason, haven't embraced it 100%. So are you missing out on technology that's out there in the marketplace to make the business run better? And then we tend to work a lot with strategic partnerships. Are there vendors, suppliers, anything else that you can reach out to that can make the business even better? Are you asking the right questions of them? So in conclusion, initially, if someone was looking to sell, oftentimes we'll get calls from state attorneys where there's a health issue and the client has to sell fast. So if we need to change that business quickly, we're going to focus on the primary drivers of the business. We're going to heavily focus on financials, the size and the growth. We want to prep the business as soon as possible to show growth trends. Other areas, if weak, are going to detract from value. So we want to make sure that we're not getting leakage out of the business, as we say. And then managing the business with value in mind. Whether you're selling your business or not, these strategies that we depict, and I'll show you how to, we have a book on this that will give you access to. Managing the business with value in mind is, even if you don't want to sell it, the most efficient and high growth way to manage a business. And then we want to identify the issues, rank them, and execute on our value improvement program. So if you focus on qualitative factors that drive value, you can fix the risks that are completely controllable and significantly increase the value of your business. The information is out there. It's all over. If you Google this on how to value improvement techniques in a business, the information is readily available. The problem is people don't execute on it, right? I was this morning on the pack of Q-tips. On the side it says, don't stick it in your ear, but 75% of people stick a Q-tip down their ear. The information whether to do something or not to do it is readily available to us all. It's a matter of actually going out there and applying it, right? So to that end, you can go to our website and download this, or at don'tsellyet.net. I wrote a book called Don't Sell Your Business Yet, and it talks about what to do before you position it for a sale. And even more importantly than that, even if you're not going to sell it, these are great operational ideas to help grow your business. This is my contact information. If there's anything I can ever do to help, I'm readily available. It's our toll-free number, and then our website's vestacor.com, and I have some business cards up here as well. Thank you. I appreciate that for your time. Thanks.